Welcome to the monthly 3-Edge View from the Edge for June. I'm Fritz Folts, the Chief Investment Strategist here, and joining me today, as he does every month, Eric Biegeleisen, Director of Investment Research, Deputy Chief Investment Officer here at 3-Edge Asset Management. And as we do at the beginning of each month, Eric and I will provide our firm's most recent outlook for the global capital markets, which is based on our proprietary 3-Edge research model. Have a lot to get to today, so let's get started. Before we dig into the model research, quick look back at May, which was a strong month for equities, not only in the U.S., but also in Europe and Japan and even the emerging markets. However, when accounting for the sharp decline in April, year-to-date, S&P is still only up around 1.5%, while the Nasdaq's higher by, I believe, somewhere around 2.75%. Percent thus far in 2025. Meanwhile, European equities are up almost 25%. Japanese and emerging markets both up around 10%. And throughout the month of May, tariffs continue to dominate the news. On Wall Street, investors struggle for some clarity, which unfortunately continues to be in short supply. However, one recent development that did occur this past week, President Trump and Chinese President Xi Jinping spoke on the phone for the first time since Trump took office. And I believe the last known conversation between the two took place before the inauguration. Despite the strong month of May for equity markets, concerns among bond market investors have continued. Yields on Treasuries and longer maturities remain elevated over concerns about trade policy, the budget/tax bill working its way through Congress, and the prospects of ever-widening government debt. And, as we know, higher interest rates also mean higher mortgage rates, more expensive business loans, and the potential for slower activity in the real economy. Additionally, the dollar is now down almost 9% year-to-date, and that is a major move to the downside for the world's reserve currency. So with all that as the backdrop to the month of June, let me bring Eric into the conversation and let's see what our model research is telling us and looking at. So Eric, maybe you could begin with our 3-Edge asset class matrix.
Absolutely. Good summary, Fritz. Yeah, what do we see here? We're noticing, you can clearly see a trend for many of the equity markets that we model and research moving to the right slowly. India, U.S., and Europe moving up, still in a mixed outlook, but maybe that's a little more optimistic than being slightly negative. Developed Asia, particularly Japan, moving up to that positive slot, joining at least an overall net positive outlook with China and the emerging markets. At the same time, you see gold and commodities, gold staying up in that top spot, but commodities moving up too. And so, if you look at this taken all together, I think the message is, it's a bit of a calm before the storm. There's a balancing act going on here between being able to participate in any further market upside, but then balancing that against the threat of stagflation through holdings in short-term treasuries, tips, and gold.
Excellent. So to try to capture some upside but remain hedged, like it. All right, so now let's dig into the model research in terms of the various asset classes, beginning with the equities, and let's start with U.S. equities, which had a pretty good month of May, I would say.
Yeah, that's right. Yeah, the model research, it's definitely improved that current outlook for U.S. equities up to that mixed spot. Despite this, and as we've said for some time, U.S. equities remain significantly overvalued by our measure. So, what's going on here? We're seeing continued uncertainty by the Trump administration's intentions to impose these tariffs on all of the U.S.'s major trading partners, and that could lead to trade wars, currency wars, surge in inflation. That may coincide or in fact be the cause of an economic slowdown or a recession, or this what we many have been talking about, this stagflationary environment. So while May brought some of that upward move in momentum measures, and that's helped the outlook somewhat, it's not convincing enough analytically to suggest that the U.S. markets will break out to the new highs yet. So we're watching that closely.
All right, great. So let's shift to the ex-U.S. equity markets, beginning with European equities, which, along with the other ex-U.S. equity asset classes, have done very well year to date.
Done very well, yeah. We're seeing a lot of market momentum and positive investor psychology measures, which continue to drive that European equity market higher. But with that said, our yield curve measure for the region, while it is steepening, and that's a positive, it's not sufficiently steep to be indicative of longer term growth. So, while the outlook's improved somewhat, it's still a bit mixed for the time being, with the potential to move up in the months to come.
All right, well, let's shift gears, look over at Asia and the Japanese equity market, another market outperforming U.S. equities thus far.
Yeah, the outlook for Japanese equities has definitely improved. We're seeing a steepening of the yield curve measure that we calculate for that region. That's a positive factor. That may be indicative of the potential for economic growth, the steepest it's been in quite some time. Additionally, investor psychology measures that we look at, those have turned sufficiently positive now too. So you take these together, and that really improves the position, as we noted at the outset on that asset class matrix.
All right, super. Let's then look at emerging market equities. What's our outlook there?
Yeah, emerging market equities are generally positive on the year, up about 6% through the end of the May, really led by the performance of Chinese equities, which are up nearly maybe 13% thereabouts through the end of May. You've had the weakening in the US dollar that continues to be supportive for both emerging market equities more broadly and Chinese equities specifically. And that's making it easier to repay US dollar denominated debts with an appreciating local currency. So far the Chinese government has taken a stronger position in the US-China trade negotiations. It'll be interesting to see what the restarted talks deliver. But they're definitely holding that stronger position than they did in Trump's first term. And so should this positioning hold, the region may be a bit more insulated by its internal stimulative measures we've commented on, as well as the potential just to shift the emphasis of their trade to other places outside of the U.S., towards other regions. So we maintain a slightly positive outlook overall.
Excellent. And then lastly, let's look at India. And what is the model saying about India equities at this point?
Yeah, Indian equities, rebounded more recently. They're now more positive on a year-to-date basis. India's yield curve measure is steepening. And so with a lag, that may become a positive indicator of economic strength in the months ahead. If inflation remains low, it's come down and it's stayed low for a few months now, the Reserve Bank of India may be able to make additional interest rate cuts, and that could also be a positive for the region. So I think we're seeing a lot of the stars aligning, but they're just not quite there yet. It's also relatively overvalued, which is kind of holding things back a little bit shorter term. So the outlook has moved up to that mixed level, and like some of the other markets we talked about, there's the potential to have a better outlook, an improved outlook in the months ahead.
All right, so now we'll really shift gears and look at fixed income and look at the bond market and the current interest rate environment, starting with the U.S. Treasury market, where there's now talk of the return of the bond vigilantes. And I think Jamie Dimon made news recently saying, yes, they're back. So what is the model saying about the rates market here?
Due to the increase in the tariffs in the months ahead that are at least assumed, we got about a month until that first deadline comes. The outlook for inflation is elevated, and that may keep the Federal Reserve in a longer term rate pause. We're also seeing tariffs on the major trading partners of the U.S. that may reduce demand for longer dated treasuries, and so that could lead to higher yields than we've already seen. And so these two factors together really just continue to support this concept of concentrating your fixed income investments in those shorter term maturities.
Certainly been the thing to do this year, absolutely. So how about the corporate bond market, or often referred to as the credit markets? What's the model saying there?
Yeah, not a lot of change here. We've said for some time, corporate credit spreads, they do remain historically tight, and that makes that additional yield one can get over and above treasuries, we think, an unappealing risk-reward trade-off at this point, particularly given the rising risk of recession too. So,
All right, good. So let's look then at, lastly, at hard assets, or often sometimes referred to as real assets, as opposed to financial assets, including both gold and commodities. And why don't we begin with gold, which has generated more eye-popping returns. So is gold due for a correction in here?
Yeah, gold maintains its status as one of the best performing asset classes in 2025 here. The tariff measures proposed by the U.S., the threat of sanctions, that's encouraged these foreign investors and central banks from around the world to seek alternatives to U.S. dollar-based assets. And so as gold is priced in U.S. dollars, rising gold price is a reflection of a weakening demand for U.S. dollars. And so, we're seeing investors' concerns over geopolitical conflicts and the relations with other countries. That's just all helping to boost the attractiveness of gold as this haven asset. And all that said, with gold having recently reached a new all-time high, to your point, Fritz, of over $3,400 an ounce, there is short-term risk of some profit taking. So that's certainly a potential shorter term. But gold continues to serve as a hedge, against the threat of stagflation and helps dampen equity market volatility during these, clearly highly uncertain times.
So I can tell you that I was traveling this week, meeting with advisors and their client, and it seems like everybody's talking about gold. And, it's an asset class that we're very comfortable with. We've always felt was important in portfolios. But, now we have the entire world talking about it, which maybe means it might have a correction in here. Anyway, moving on. Commodities. I think you said that commodity outlook had improved. What are we seeing there?
Yeah, the commodity outlook did improve. It went from a slightly negative to more of a mixed outlook. Commodities broadly could benefit, like gold, from the prospect of a weaker dollar for all those reasons we outlined above. But the prospect of a global economic slowdown, that is the result from the threat of tariffs and trade wars, et cetera, that's going to reduce the potential for the demand for commodities, hence the mixed outlook.
What about oil? That's come off a lot, right? Or have we started to see it tick back? Or
yeah, I think there's been some calls for oil to rebound. It has been in the low 60s per barrel, and been stuck down there for a bit. Should be interesting to watch that as well, particularly given all the geopolitical conflicts out there.
Yeah, excellent. Okay, great. Eric, thank you. Thank you for providing our 3-Edge outlook during these very uncertain times. So that will do it for this month's 3-Edge View from the Edge. Eric and I will be back in early July with another edition of the monthly 3-Edge View from the Edge. And if you'd like a hard copy of our full View from the Edge newsletter for the month, you will find that on our website, and that is the number 3, edgeam.com, 3edgeam.com. As a reminder, all of our content is available on our 3-Edge YouTube channel. You can just go to YouTube, type in 3-Edge, and you will find all of our content there. If you like the videos that you see on our channel, we would be most grateful if you would subscribe. So, on behalf of Eric and everyone here at 3-Edge, thanks for listening.